This is the Converge Podcast, brought to you by the Converge Institute. Each week, brilliant minds specializing in AI, blockchain, and fintech come together to challenge the status quo and empower disruption. Sponsored by our founding council, Nacusa, BankSocial, the Texas Blockchain Council, and the Universal AI University.
All right, here we are on the Converge Podcast. I've got a really exciting guest with me today. This is going to be really fun. Brad Oates. Thank you so much for joining me today on the Converge Podcast. How are you doing, sir?
John, my friend, it's great to be with you.
It's fantastic. I'm glad we finally got some time to pull this all together and get in and do one of these in-person ones. It's rare that we get such an esteemed guest, and it's even rarer that we get to do these in person. So this is really fun. It's going to be really fun and really cool today. Did you like our setup here? It's pretty cool.
I love this. This is cool. I feel like I'm in part of a real broadcast here.
I know, right? It feels pretty cool, like a real broadcast thing. So let's set a little bit of the we have a lot of financial institution partners. We got a lot of people interested in finance in this space, and your experience is really, I think, the breadth of experience you have and just the knowledge that you shared with me in the few times we met. So we'll talk about how we met a little bit into that. But then go into your experience and then we'll get on to kind of your white paper and some of the other stuff you've done here that really helped us connect, on a much deeper level. But we met in, of all places, the sauna, right? I think we'd seen each other a few times in there. And then you said hi. But why don't you talk to us a little bit about your background? I know, I'm a college football player, but you made it all the way to the NFL. How do you go from NFL to finance? Take us through a little bit of that story.
Well, 2 hip replacements and a knee replacement. Thank you, NFL. But I grew up in Georgia and football was king, and ended up going to Duke University and then transferred out to Brigham Young University and was fortunate to play for the great LaVell Edwards, and then got drafted by the Cardinals when they used to be in St. Louis, and ended up playing 8 years professional football and went to law school in the offseason.
That's right.
Yeah,
the football lawyer.
Yeah. And I knew I needed to do something. I had 4 good years and 4 tough years where you kind of move around from team to team.
Yep.
Played for the Cardinals, the Lions.
Offensive line, right?
Offensive line.
Yeah. Yep. Tackle.
I was offensive tackle.
Yeah.
Played right tackle and left tackle. I have a nephew who's playing for the Broncos today. My brother, younger brother, played with me my last 2 years, was his first 2 years.
Oh, you got not on the same team.
Yes, we actually did. So
how cool is that?
It was cool, a lot of fun, and but I knew a wife and 3 kids and a couple of knee surgeries at that point, and it was
while you were playing. You had a wife and 3 kids.
Yes, yep. And I the last 2 years were some tough years physically.
Yeah,
I was at the end of my career, and I could tell it, and so decided I wanted to be a lawyer. I thought I wanted to be a litigator, a lawyer.
That's what you see on TV, right?
Right. Perry Mason.
Yeah.
Came to Dallas. I had a friend who had bought a bank when he was 19 years old.
Wow.
Here in the early 80s. And he needed a general counsel.
Like a savings and loan
Yes.
bank?
He bought a savings loan down in Stockton, Texas.
Yeah.
Moved it to Dallas. Ballooned it up. Grew it about tenfold in 2 years.
Wow.
Did real estate lending all over the country, from California to South Carolina. And needed a general counsel. I went, well, I don't know if I were him, I would have hired him, but he did. And I still had a contract to go back and play. And we agreed I'd come and do it for 4 to 5 months. He'd try me, I'd try him.
While you were playing?
Yeah, I still in my last year, but I kind of knew that if this was going to work out. My brother wanted me to come back and play in 85. So this was 1984 at the end of the season. And I kind of liked it. I kind of started to learn what I didn't know. You don't know what you don't know until you know it.
Mm-hmm.
The savings loan, Stockton Savings at the time, had not yet gotten into trouble, but within a year of coming there and starting in 86, trouble hit. You could see it.
Market trouble or it's systemic inside the institution, really?
Mainly in the Southwest.
Yep. So market situation in the Southwest.
Mainly real estate driven.
Yep.
Texas was the epicenter of a real estate bubble that had grown. And in fact, many out-of-state savings loans and banks bought participations here in Texas.
Mm-hmm.
There were probably 300 thrifts when I first arrived. And a couple of years later, there was less than 100.
Yeah,
less than 100.
Yeah.
Again, there were 16,000 financial institutions, and we're down to 4,500 FDIC-insured banks. And
a same number of credit unions.
Yes, that's right. And consolidation is occurring, including credit unions acquiring banks.
It's crazy. Which
last year was set a record.
Yeah.
But I started out.
See, I knew they'd like you. You know all this stuff. You got it all.
Well, I guess in the fourth quarter of your life, you kind of look back on the first and second quarters and things I learned. Probably the best thing was riding trouble. Just either I was attracted to trouble or trouble found me. And I just started to just be in the right place at the right time to be a turnaround guy in the banking world. That was what I was good. And a lot of that came from being able to see forensically what causes bank problems, not just on the credit side, but on the operating expense side, cost of funds, all the things that are the fundamentals of banking. And
so you're like the guy, just so I could paint a picture here, you're like the guy from Beautiful Mind that comes in and looks at financial statements and sees this whole thing happening.
Oh, it is so hilarious because I was never really great at math, and I ended up. And in law school, the only class I ever got a C in, and I was not a great college student. When I got to law school, I said, okay, I'm going to really be competitive with the best of the best. And
this was at BYU, right?
Yeah, I went to BYU law school. It took me 5 years to get through because I was playing football. And the only class I ever got a C in was corporations. So you can't make this stuff up. But anyway, I ended up, in a banking career, and particularly troubled banking career.
Yeah.
And that followed me from the 80s into the 90s and into the 2000s. Then I became a receivership assistance contractor through Stone Advisors. And we did about 50 bank closings, mainly as a subcontractor to Deloitte, and then some directly for the FDIC. And so it just seemed to be that. And then I end up on the board at CIT, which was the largest TARP loss that the government had in the great financial recession.
Oh, wow.
And it was a complete reset of a commercial finance business, but had a Utah bank. And I sat on both the holding company board and the bank board. And then we sold that. We merged CIT with First Citizens Bank, which acquired Silicon Valley.
Yeah, just recently.
Just 2 years ago. So,
man,
and here we are now with a bit of an unknown going forward.
A bit? just a bit?
A little bit of volatility.
So did you do conservatorships? Did you ever get tapped for conservator? Is that mainly what it was, is conservatorships?
Well, there are differences between conservatorships and receivership.
Yep.
When the primary regulator puts a bank into receivership, they really say it's broke.
It's done.
It's done. They've
it's
taken
done.
it, and then they give it to the FDIC as the receiver because they're the deposit insurer.
Yep.
And there's two ways that banks go broke. In the first couple of cycles in the 80s and 90s, we should step back and say that in the 80s, I would call these rolling regional bank crises.
Okay.
It was started here in the Southwest, probably the mid-'80s to late '80s. And in 1988 was when the FSLIC, which was the insurer of the savings and loans, was basically broke.
Basically the FDIC for the savings and loans.
Exactly.
Yep.
And in fact, it was broke because it did not have the money to close all the savings and loans.
So too much leverage.
Well, that's right. So all the
insurance leverage.
thing. And as a result, they did what was called the Southwest Plan. There were 10 transactions that were done in 1988 with over 100 savings and loans.
Wow.
The Bluebonnet transaction, Bluebonnet Savings Bank, was the one that we did 15 failed savings loans in a single transaction.
Wow.
All the way from Texarkana to El Paso, mostly West Texas.
And what was the total asset allocation size?
In the
Couple
$5
hundred
billion
Oh, wow,
range.
$5 billion.
Yeah,
Wow.
$5 billion range total assets.
Yep.
And there was fraud. There was every kind of situation you can imagine. We had
Internal fraud?
Yes.
Oh, wow.
As I recall, probably about 25 former bank officers ended up being charged with bank fraud out of those 15. But the day we acquired it, I remember we acquired these sight unseen. You just
looking at numbers?
Well, it's a purchase and assumption agreement.
Mm-hmm.
But because the FDIC, which took over the FSLIC, offered a loss share, they guaranteed a yield maintenance on the assets and covered the losses. So, and what they were really doing is buying time to recapitalize the FSLIC, which then was merged into the FDIC.
Yep.
But it was a great experience. Day one, we had 20,000 bad assets.
Wow.
20,000 bad assets.
Day one.
We had 3,000 repossessed homes and mobile homes.
Wow.
And how many pieces of litigation? Probably 500 different litigation that are being handed to us to resolve on behalf of the government.
Yeah.
It was a public-private partnership, essentially.
Yeah. This is all with Deloitte as well? Or no, that was later?
Here, yeah.
Then was saving below.
This plan.
Yeah, wow.
And then this real estate crisis went to the Northeast and affected the Northeast and then went to California.
Mm-hmm.
Whereas in the Great Financial Recession, it was nationwide, mainly mortgage related, but it pulled many other banks in with just commercial real estate as well.
Yeah.
And the Great Financial Recession was really sparked by the Lehman moment.
Yep.
When the regulators decided, it wasn't so much that banks wouldn't lend to you and I, is they wouldn't lend to each other.
Yeah.
And that's what caused the liquidity crisis.
Because they let Lehman fail, basically.
Yes, that's right.
Right.
It's liquidity.
Yeah, it's all about liquidity.
And, if a bank has liquidity, you can ride through unrealized losses and even some capital erosion to be recapitalized
at a later date.
But when liquidity, like we saw in 2023 with Silicon Valley, First Republic, and Signature, these were not asset failures. When we think of those failed banks, we think, well, it was because of bad lending. No, it wasn't in bad lending. What had changed was the fintech apps that now are part of the equation that allowed $40 billion
Move
of
quickly.
deposits to go out in one day from Silicon Valley.
Yeah.
And that's a new factor because we have a generation of younger treasurers and CFOs who've never seen what we saw from the 80s. I mean, interest rates were, for over 45 years, interest rates went from
15, 20,
18% Fed discount rate all the way down to basically zero.
Perfect.
And on a real rate, we were negative.
Yeah.
In other parts of the world, we had negative.
Yeah. You have to pay the bank to
Pay the bank. I mean, put your head around that. Now, that reversed pretty quickly and has led us to where we're at today. And even though the Fed cut rates, raised about 500 from 2022, and then has cut about 100, so we're net up 400. But the 10-year rate, the 10-year Treasury
still
went back up.
Yeah.
And it was interesting that just in the last couple of days, the new Secretary of Defense has basically said they're going to focus on the 10-year Treasury, which is not really set by the Fed. It's the market that's setting 10 and longer rates.
Interesting. Why do you think the divergence there?
Well, so the Fed discount does influence short-term rates. And clearly, over time, we saw the Treasury, who is in charge of funding the U.S. government, not just the maturing treasuries, but the deficits that have to get financed, which is really what the white paper was about, with new treasuries. And as we have gone shorter and shorter and shorter, the Federal Reserve and the Treasury is actually doing what banks should not do, which is funding yourself shorter and shorter in a falling rate environment, which gives you the benefit of lower and lower debt service until rates turn.
Yep.
And when they turn, the debt walls are larger and the overall interest costs are more expensive.
Yep.
And if you're not hedged, now the Treasury might say, well, we are a hedge. We will just continue to roll and we'll fund more debt. But the markets are saying, well, if inflation stays higher than expected, why would I buy the long end of the curve? And this is where the market is speaking. The so-called bond vigilantes are basically saying, Fed, you can either raise or shorten short-term rates, but if you want me to buy 10-year, 20-year, and 30-year bonds, you're going to have to pay me a premium because I'm concerned that I'm going to get paid back with, deflated,
currency,
a devalued currency.
Yeah. Well, coming back to the fintech, you said the fintech kind of unexpected and the younger and younger generations running these places, maybe they don't have experience. They also might have this kind of Amazon mentality where now I want to pull my money now. We need to build systems. I think we are seeing a lot of this. One of the things that we're also seeing that I think maybe plays into this entire equation is the dollarization, the re-dollarization of the world. There was a period of time, call it for the last 8, 10, 12 years, where we were concerned with BRICS and concerned with other currencies and concerned. I think one of the things that maybe this more easily movable money, it's caused fraud, but Kyle Hoffman of the NCAA, he's now the chairman, he just became the chairman. He always says to everywhere we go, and there were no airplane crashes before we had airplanes. And, some of this stuff is figuring out the kinks, but what are your thoughts on this re-dollarization and how that plays into the equation? Because we are seeing a lot of countries, I just came back from WEF and Davos. We're seeing a lot of countries want to hold dollars. They want to hold these new stable coins. I'm sure you've heard about these.
Yes.
How do you think that plays into the equation?
So it's a bit of a conundrum for the current administration. In one sense, keeping rates high to fund the government, both the debt wall and is also keeping the dollar strong.
Mm-hmm.
But if you're trying to attract capital and have people build factories here and reshore, which is a great thing, that's hard to do with a strong dollar. So there's a bit of pool here that I don't know who's going to win.
Mm.
What is for sure is that King Dollar is still the king, but we should acknowledge that a number of countries, whether they're subject to sanctions or whether or not they have dollar-denominated debt that now is more expensive for them, which is a big issue. Trying to figure out, could they uncouple from the dollar? And then the whole geopolitical separation overlaps that as well. It gets pretty complicated pretty quickly.
It does.
What I tell you is that it may be that we are the cleanest dirty shirt in a world that is geopolitically separated. For sure, a macro trend is the rise of populism and all of its reordering. We're seeing that even among allies as well as those who are not. So that's occurring. The other thing that is occurring is technology disruption. Blockchain, fintech is here to stay. No question. AI, and then we go to quantum and other things that even are, and the speed of
getting crazy.
The speed of change is for sure.
Yep.
Technology adoption, technology platforms, and it's created an issue of having scale and innovation in banking, in financial services generally, for sure.
Yep.
the speed of change is challenging leaders in the financial services world, and I include the entire ecosystem.
You're absolutely right.
That to really be challenged.
We were just talking to a financial institution when you were walked in, and that's literally. And the smaller you get, the more you're relying upon outside vendors and factors and all that, and it gets you've got to really make a determined effort to say you're going to innovate and stay at speed, and understand that sometimes things are going to maybe not turn out as ideal as they should.
Well, it's an interesting time. I also think that you're right, and companies like yourself have done a great job in helping support innovation. Where the financial services, they've got to decide, are they going to put their talent, money, and focus on the back end, or really on the front end, on the customer side, really serving customers and have a good, reliable partner.
Yep.
What's more complicated today is all the cyber issues that are part of a connected ecosystem.
Oh, yeah.
The mere fact that we have kind of open source, when I use that word, basically the openness of the internet and technology systems that were initially architected that way to lower the friction that would otherwise be there, works to create the issues that we have to deal with, because it only takes a handful of bad actors that can, run it for everybody, all the good people.
That's exactly right. I mean, that's a lot of what we build around and deal with is the evolution of those systems to make these ecosystems safer and safer. I mean, that's the major factor above all others, maybe, is that, because you can innovate, you can be fast to market, but if it introduces a whole bunch of new issues, is it really a good solution?
Well, I think that was something that when we first met, that it resonated with me, because I think we're in an era of organizational resiliency. That's the buzzword of this decade.
Break that down a little bit. Organizational resiliency.
Well, so I'll say first that one of the things that attracted to was I thought I could see the innovation, that you were naturally, intuitively innovated. You had this team together.
Thank you.
And you could do that. But you were balancing it with a cognizant, intentional resiliency purpose. That couldn't be just innovation for innovation's sake, but it had to have redundancy and reliability and all those things.
Absolutely, yeah.
So when we think about organizational resiliency, a lot of people say, well, isn't that enterprise risk management? It's that plus more. One way to think about a framework, there's multiple ways to think about it. This isn't the only way, but is one way, which is your business model resiliency. That's more than just technology. Technology is there, but just business model resiliency.
Yep. Financial,
competitive, and just being able to, have it resilient and withstand enough slack so that when you have these disruptions that are going to be in every life cycle, that you can withstand that.
Yep.
The next is, people resiliency. It's great to have system resiliency and just business model resiliency, but this idea of a resilient organization is critical.
No, you're absolutely right.
And in a post-COVID world with isolationism and all the things that we're seeing, and with the social macro trends, this idea of resilient workforce and is going to become even more of a differentiator between the best in class and the rest of the pack.
So that's interesting, because yesterday I was talking with a gentleman is a former the chief economist for one of the feds, and he's now a professor at DePaul. He deals a lot with this stuff, and we were talking the other day, and we both hit on something where it's like you also have to start rethinking maybe how AI fits into an organization, because it's not this IT thing that you just kind of push across the organization. It literally could be agents or workers, or, you have to rethink the resiliency of your organization from this paradigm shift we're having. How do you make it more resilient with those enablements and these new, not just, I don't even know that AI can be considered just the technology. It's really all this workforce that is coming. Does that have any thought?
Oh, I think you've hit something that we're in the early innings of trying to figure out. One way to think about AI is the way I think about, football. There's offense and defense. Most of the conversation, I deal in the governance world a lot. And most of the corporate governance world is thinking about governing a company's use of AI as a corollary to cybersecurity and then data privacy and now AI. They all overlap.
They absolutely, yep.
Within a company, however, they are dispersed. You'll find the CIO dealing, the CISO will be with cybersecurity, but the general counsel will be dealing with data privacy. And AI is kind of this nebulous, maybe under the CTO or somebody else. And then we have cyber insurance on top of it. So corporations are trying to figure out how to organize internally.
Yeah.
And boards are trying to figure out how do you deal with cyber risk governance more than just cybersecurity technology. But in AI, governing the use of a company, or misuse is probably a better way of describing it. It's really misuse. Yeah. You get into not just data privacy, but you have IP theft and lots of other issues. Data that these large language models are trained on. Who owns that data and what rights someone has in perpetuity are all things you're going to have to get worked out. But the other side of the coin, and this is the competitive advantage side, if you think about offense, defense is resiliency and offense is competitive advantage, sustainable competitive advantage. It's being able to integrate AI to help you do the things that human intelligence would only take you to so far. Now, I think it's important to acknowledge here that we don't know until we don't know. And we should think about AI almost in three ways, 1.0, 2.0, and 3.0. 1.0 is what I did 25 years ago with RiskWise, a company I sold to LexisNexis. That was a parallel to what I was doing. And that was in the predictive analytics and the fraud prevention. And we were using neural net modeling, and we were doing parallel processing to bring back scores in sub-second latency to determine whether a transaction was valid or not. We didn't call it AI, but it was AI.
There was some machine learning, probably more machine learning and doing an analytics on machine learning.
Yeah. Yep. AI is a term much like corporate governance.
Yeah.
But really predictive analytics.
Yeah.
Now we're in 2.0, generative AI. It builds on all the predictive analytics because what it is doing is predicting what the next token would be.
Yeah.
Now, why it has hallucinations is a whole nother discussion.
Yeah.
And so we're now into an incredible, and it's moving at light speed.
Yeah.
The new reasoning models that have just come out and DeepSeek and everything.
Have you seen Deep Research?
The DeepSeek the deep research that it does for the academic research?
Yeah, so just a few days ago, ChatGPT or OpenAI released Deep Research, which is a research tool now to write whole papers for you,
exactly.
Graphs and charts
in
minutes.
Yes, in minutes. And in fact, Perplexity and others have come out with their reasoning, these advanced reasoning models.
Reasoning engines,
And that's only going to get better. And that is on the way to 3.0, which is artificial general intelligence.
Yeah.
Okay. So today, really, it's about the prompts and the context and everything to be able to leverage AI, and I call it to augment our human intelligence. And this is kind of the revenge of the English majors and philosophy majors, actually, because it actually requires you to frame the question and first provide the engine the context.
Yeah.
Today, people are used to looking at AI almost like Google search.
Yeah.
Yes, it will do that for sure, but being able to leverage it to augment your human intelligence, we're in the early innings. When we get to 3.0, which is theoretical at this point, but there are a lot of smart people working on it.
Have you heard of the singularity?
Yes,
Okay.
that's what we're talking about.
Yeah. Okay. Yeah.
That's what we're talking.
Yeah, we're talking about the singularity.
Basically, we started, more than 25 years ago in this predictive analytics, and this is a progression of human innovation in such a stunningly historically short period of time.
Yeah, I know.
I mean, it is leaving some people behind. It's creating separations in many ways, but it is here. So people are going to have to adapt to this world, and it is going towards this.
Well, it might be making longer connect. Like, there's some things coming out now where you can take, your parents' Facebook or something and create an AI model of them that lives and answers questions. And
yes,
it's
the living. Yeah, it's mind blowing.
It is.
I mean, what we're 2.0, which I call generative AI, and that's my words for this 2.0, is moving even so fast.
Yeah.
Where we'll be at, I don't know. There's a lot. I'm not as techie as that
What people
might
aren't taking into consideration is people are thinking of, so there's a concept that's, it's like pulling stuff forward too, right? So AI is part of this new chipset and this quantum chipset that's coming out, right? Like the new I can't remember the name of them, but the NVIDIA cards, they can process the whole internet across the bridge on a chip this big every second.
Yeah, it's phenomenal.
And quantum, people don't realize that quantum is getting faster every day and making this stuff faster and faster. And we can't even process what quantum means.
Yeah, and quantum, you're right.
Yeah.
And that again, it's almost like we don't know what we don't know until we get there and can see it and experience it. We'll find some ways in which probably some of it was overhyped, at least in time frame.
Yep.
The adoption will occur.
Yep.
And then some of the not so good, we'll have to experience it firsthand. That's been the case for centuries, of human innovation. But for financial services, particularly for your audience, absolutely, the idea of technology as an extension of us is going to be as much, well, let me step back and say, you could think of technology as a tool, and it is. But now we've reached the point where technology is actually an extension of us. And that is different. It's a different way of thinking about technology. And so when I think about financial service providers, the cutting edge, the ones that are the most innovative, will be able to take all that they have in terms of providing tools and now have technology that allows their customers to be extensions and create the relationship and the conversation. The first time I used ChatGPT and started to learn how to have a conversation with a machine and say thank you and it say, can I help you with anything else?
Yep.
It took a while to really wrap my head around that.
You mean even from like what to say, when to say, how to say it, right? It was weird. Not like you and us talking right now.
Yeah, that's exactly right.
Yeah.
And it was like my manners. It was, in a way, it was kind of funny because I grew up in the South and you say, yes, ma'am, yes, sir.
Yeah.
And here it was. I almost felt like, yes, sir, no, sir. They would come back to me very polite.
Yeah.
It was like a butler, a concierge, almost. And you were having to really think about that and how you do it. But one of the most fascinating things was after these prompts, and this is what I invite your audience to think about, just try it. After you use AI and you've gone through, you may go through multiple prompts, responses, refinements, and everything. If you ask the engine, whatever AI engine, okay, tell me the non-obvious. Tell me something that I need to know that I might not know. And you would go, well, it's already told you everything it knows that you respond to your prompt, you'll be astounded by the response, we'll call it the response, that an AI engine will give you when that final question of asking the engine to tell you what might be non-obvious.
And the way I've done this before, but with coding. So with coding, you look at it and you see the code, and then you're like looking at it and you're like, hey, is there a better way? It's very similar to this, right? Yeah. Hey, I'm not really seeing it, but this code looks weird. Is there a better way to do this? And it's like, oh, you're right. And we forgot to look at this, and you're like, oh my God, like this thing just went down a whole nother path.
You're asking the machine to think out of the box.
Yeah.
You're asking the box to think out of the box.
Yeah.
And it's so counterintuitive, and yet it comes back with a different answer. It has a different, all the people who do all the algorithms, I want to talk to them someday, or maybe, but
they tell you, they don't even know how it comes to the decision sometimes.
Well, and this is why we're on the precipice of this AGI, or the singularity, where it thinks on its own. Now, what the
thinks with us. So I have a hypothesis that it's going to think with us. So, to me, it's now become more than even an extension, and it's becoming a time travel tool. Yeah. You can move now in multiple areas with their agentic AI is coming out, where you're going to be able to tell that AI to do this and that one, and it's going to say, I couldn't do this. And now you're going to be, and as we get the interface between our think at speed of light brain interfaces with another think at the speed of light machine, it's just going to be, that's the closing of the gap to singularity.
I had not thought it exactly the way you expressed it, but it's a really brilliant way of really describing its thinking with us.
Yeah.
Now, question I'd ask is it bred, to manipulate us in some way? Will it, just like it took thousands of years to have fighting dogs and build viciousness in certain breeds versus other breeds, are these machines going to be competitive by nature to either try to make sure they outthink us or outthink each other?
I think it's like, here's what we have to be concerned with. Because this is compute that's tied to each other and all this, what we have to be worried about is this arms race, right? Because there are bad people training these models. And if these models have enough compute power and they can train it's all like a kid. It's like a kid, right? And it's an arms race almost. I think, this is like the little edge thinking, but if these bad models or bad actors have enough power and have enough compute power to train other models and deploy those models, it's going to be a constant battle to see how you can stay ahead of that stuff, and governments may train the AIs of other. That's why openness. That's why I think Elon wanted it to be open, wanted all these to be open, and is trying to push for that, because that's kind of one of our only saving graces, is if everybody can look at what's making the decisions. And I think with blockchain and DLT, our ability to, like when you said, if you train a model, expirations, should it still be holding on to your data? Is it, eventually it'll be able to pay you for you training it? Like, these are all things that will be happening in the future. And I think if we maintain that state of open systems, open connectivity, distributed ledgers with AIs, with open, token training data models and all those, we'll be okay. Otherwise, I think that, if these become centralized closed systems, it could be a dangerous world.
So, John, let me ask you a question about that. When you talk to your clients, there's blockchain in DLT. Distributed ledger technology certainly is the kind of the more technical way to think about that. And then there's this AI. They overlap, but they're different. How do you recommend that your clients think about, in the financial services world, of how those fit together, and how should they think about those?
Well, you mentioned the word tokens. And so I think there was a deliberate, or maybe it was non-deliberate, it worked out very well, but AI has the concept of tokens, where, all the elements of the learning model, and then it figures out how to pull tokens together. But you can look down in the tree and look at the tokens that it used to come to its decision, and those DLT also has the concept of tokens and tokenization. And when you overlay those two concepts, the AI token model and tokenization on distributed ledgers, you can now create a network, whether that's, DLTs are getting faster to run on private, little smaller phone networks, AIs, smaller language models and smaller learning models. So Apple just released their private, they did the whole open AI thing, but what they also did behind the scenes was they, in iOS 18, made it so that smaller language, local language models can run within apps and share data with zero knowledge proofs. So when I say how this stuff is going to work, you really got to be open to it. Yeah. It's going to manifest itself in so many different ways, from on-device fraud detection, where you're not having to worry about privacy concerns because the model is so sophisticated on the device. So it's basically gonna, everything you do now. It's like we came up with this tool for combating fraud in the digital banking app, and really it's doing what they were doing 30 years ago. It's like, oh, Brad, it's great to see you again. Oh, you want $10? Absolutely. I know you, Brad. Yeah. We've stopped doing that. And so really a lot of this stuff is cyclical. And I wanted to talk to you about cycles and where you think the cycle we're in right now. We'll get into your white paper. But that's how we really have to look at it. It's going to impact, again, it's not a tech thing that you push sideways across the organization and you say, oh, yeah, put it on our servers and put it over. Everybody in your organization, every system in your organization will be augmented or benefit from or be impacted by the use of AI against it, with it, for it. So you have to really start looking at every process. You almost have to rethink how organizations of the future will be built. You may have whole teams that are AI teams. The first billionaires will now be single loan billionaires with AI, agentic AIs happening. And you have to look at it like a regular business. So I think the most prominent places we're seeing the conjunction of AI and DLT is, of course, in payments. We see a lot of that in payments. We see a lot of that in fraud detection, right? We see a lot of that in now robo-advising, on-the-device robo-advising. People were concerned with some of the early robo-advisors because are they sending private data to even if it's a private language model that's centralized, do you have the proper disclosures? How much more, are you having to put into your compliance and back end to disclose to the consumer, versus if you just had a private local language model, you probably don't have to disclose as much because you're not sharing data. So we really see it impacting, kind of that front end experience, both for the consumer and for the employee servicing the consumer in those various places. But yeah, it's pretty exciting. But don't interview me. That's not the whole.
I want to learn. Surround yourself with people smarter than you, and that's why it's very. That's why I brought change.
So let's talk a little bit, kind of that whole cyclical thing we just talked about. I think, you're seeing you've mentioned to me at least that you see some cyclical potential things happening right now. You wrote a white paper on debt. Talk to me about what you feel the current, and I know this is all prognostication of where we think things are going, but you've been around a long time. Where do you feel like the U.S. market will really focus there is going to be? And, does it get impacted by global markets? I know we've been talking for a couple months now on this, but what do you feel is happening here? And how has there been a reset? Are we on a new trajectory? Is it?
So since we talked, we have a new administration that has come in, and that certainly is going to be an impact.
Yeah.
And I'm a political independent, so there's more observations, and that is the uncertainty of the world that we knew that had this particular institutions in order and everything was coming apart even before the recent election.
Yeah.
The rise of populism, the rise of nationalism, across the globe.
Yeah.
We've seen that. So that's a macro trend, that's for sure. What it feels like to me is that we are now in a permanently higher cost of capital environment. And that's important to note because for 45 years, we were going to an ever lower cost of capital environment till we got down post-Great Financial Recession to basically
Bring money.
negative real rates. And that's exactly what you would expect in minting a bunch of MBAs over 40 years to learn how to make money on money. And leverage is what you would use to do that. And we see that across the board in many financial sectors. So if we are in a higher cost of capital, the ramifications of that are, particularly for financial businesses, that assets on the balance sheet today that were originated at a time when there was a lower cost of capital, which are the majority of the assets in a $75 trillion financial system, both banking and non-banks, are devalued. Now, with liquidity, you can ride through devaluations. You might have lower, with cost of funds having gone up and asset yields not being able to catch up, and there are outer boundaries to where asset yields can go. And we're seeing that with some of the refinancing. Margins are getting squeezed. And that's happening today. And it feels to me like things are converging. I think it's the convergence. It's not a single factor that causes a distressed banking cycle. It is the timing and convergence of multiple things that leverage together. We have liquidity issues today that we did not have in the prior distressed banking cycle. Liquidity is just a materially more important, and particularly with the cost of capital, as deposits can flee out of financial institutions in search of rates, and then you have uninsured deposits and other issues that are at work. I could be wrong, and nobody should, certainly not investment.
Get your pens out.
The disclosure. But I think that it's better than 50-50 odds that we will have a distressed banking cycle in the next 18 months. Now, is that a small one or a medium one? Is it globally connected? I mean, there are a lot of things yet to play out.
Yeah.
But what we see is a couple of things. And this was pointed out to me by my former treasurer. A lot of people thought the economic train was going to go off the track a year or two ago. Yeah. And it didn't. And in fact, the U.S. had the strongest economy. You see definitely in Europe, China, even India is slowing down from where they were. Yeah. And people went, well, okay, we must be stronger. Well, part of that was the pace of government spending. And by that I mean, if you look at consumer spending continued to stay strong. We still had savings that from pandemic, and we had credit lines that are being used up. You see it in the data. You have buy now, pay later. You have other things that have kept consumer spending relatively high and actually increasing. At the same time, we had record budget deficits. Again, certainly coming out of COVID for sure, but even after COVID, we had the CHIPS Act and the Inflation Reduction Act. Not saying whether they're good or bad. The fact is that kept government spending high too. If consumer spending slows down together with government spending, meaning it's not that it stops and decreases, it's that the rate of increase slows down. Together with business capital spending, which is definitely slowed down, then it's the convergence of all three of those factors that will mathematically have some negative impact on the economy and ripple through, at least short term. And you can't rule out that we could even be in stagflation. Have the 70s called and want their stagflation back. And that's where the GDP growth is less than the rate of inflation. And if we are range bound in inflation, Fed has a 2% target, but if we end up in the 3 to 3.5% and growth goes from 2 to 1%, we're kind of there by definition. People are losing ground. Now, the proverbial boiling the frog by degrees, and this is frankly what the market for the Treasury market is concerned about, because why invest in the back end when you can get 4.5% at the front end? But once you get on that addiction train, it's going to be really tough to say, okay, we want you to buy the back end.
Yeah.
Now, will the Fed go to QE and grow its balance sheet back up? Will it use the banking system to monetize the debt? A lot of options on the table. They'll all have consequences.
Yeah.
At some point, fiscal policy, and I look at the Fed, and people blame them for a lot of things. I think they're overblamed.
Yeah, I agree.
And
easy to blame.
Yeah, and even presidents get too much credit or blame for an economic outturn.
Yeah.
This has happened decade by decade, year by year, and we've become used to what we have. And at some point, the debate we're going to have as a country is, can we afford what we have become used to? And would we, as a country, even elect somebody that might have to take something away from every one of us to right-size the ship?
Well, that's kind of what's happening right now, right? They're taking away a lot. A lot's being taken away, but you're right. Government spending is coming down, or attempting to come down heavily.
Yep. That's right. And to think that there won't be to think that it will be a pain-free reset
is not the right way to think about it. Yeah.
Now, whose ox gets gored and who bears the pain, and haves and have-nots, there are a lot of tough, thorny issues.
Yep.
And when you slam the door on what we've gotten used to for so many years, the way the world worked, and that's probably the biggest issue.
Yeah.
If there's one takeaway, it's that fundamentally, we have a changed world with increased risk. We have multiple macro trends that have converged, together with the separations that are occurring geopolitically and socially, and the tribalization that is occurring. I'm in the fourth quarter of my life, football metaphor. And, I think of my children and grandchildren and others. So, those are, and with the teaching I'm doing, at University of Texas, at Dallas, I'm asking myself more of the strategic questions. It goes along, all the metrics of banking, and now we're really into kind of fundamentally what holds a people together. What's that common glue? I'm a very strong believer in bottom up. Top down meets bottom up. When I think about championship teams, I go back over and over and over again to this trilogy of they're organizationally resilient, they're strong defense, they can push the ball down the field and score, they have sustainable competitive advantage, they're innovative, they're thinking, they move fast, they're agile, the recognition of what the play is in front of them and ability to adapt and move to where the puck is going to be at rather than where it's at now. And then this intangible of trust, this intangible and trust of championship team culture, the trust. Why do certain teams win consistently with seemingly less athletic talent?
Or as best as everybody else out there, yeah.
Well, so Andy, the Chiefs, and I played for him. I was hoping my Detroit Lions might, have a chance.
So who are you going for in the Super Bowl then? Kansas City?
Oh my gosh! Well, I like both of them, but probably I'll because Andy Reid is a good friend.
Yeah.
I'll back him for a three-peat. Interesting enough, just 2 years ago, the Chiefs were the it team and Midwest values and the whole bit came out of it. Now they're the villains. They're like, the refs are for him and he danced to everybody else. And so, but I just hope it's a great game.
I think it will be. I think it'll be a pretty good game. Yeah.
But their trust. The one thing I'll say about Andy Reid and with all the great coaches, and there's others too, like from Vince Lombardi on down, they were able to establish a trust culture, not just among the team, but with the fans as well. And that is one of the things the Chiefs have done well. Other teams have done well too. I mean, look at the Cowboys. That's, of course, America's team for.
They have a little, they have a little bit of an advantage there. It's hard to do it in a place like Kansas City.
It's hard to do it in Kansas City. Yeah. But it's been fascinating to sit back and look at the things I experienced. I've almost come full circle because, I started out, sports was kind of what I did and a great career. And now when I look at the world I'm in now, more coaching, teaching, mentoring, writing, these fundamentals come back. Again, resiliency, innovation and competitive advantage in this trust. I think that probably for the younger generations, in a world that's driven with digital transactional relationships, let's face it, we become pretty transactional.
Yeah.
That's the de jour kind of relationship default. Relational is something different, and I think it's going to be a real challenge in a tech-driven world to try to find the balance of tech enable us to be even more transactional versus augmenting our ability to be relational. And AI brings that front and center, because if we want AI to be an extension of us, what does that mean? Does that mean it helps us to become more transactional, or does it help us to become relational? That is the key question that I think transcends business. It strikes at the heart, but it's really, when you think about financial services, trust is what keeps a financial services ecosystem intact.
It's the glue.
If you lose it, like deposits,
everything's gone.
Then it's gone.
Yeah.
And I think we're going to be tested as to whether or not we have an underlying fragility that has been building, in which technology has exacerbated the fragilities that have built year by year. And the system collapse, the complex system collapse theory is everything holds together until one day it doesn't anymore. And the elevator goes from the 20th floor, it doesn't stop at the 19th, 18th, it goes from the 20th to the basement in one swoop. And that's the unpredictability
of complex
that we have in our world that has moved at light speed of change that almost leaves us behind to think about the strategic things that glue us together. I hope that one thing we don't lose is, I think we leverage, and I'm, trying to learn everything I can about AI, but I hope that we never surrender our human intelligence. That, to me, will be a bright line that will not turn out well. If we could use AI and quantum and everything else that is on the way, and it will be here, to augment our human intelligence, what makes us unique. But if we ever surrender what makes us human, and that's a relational quality more than transactional.
Yeah.
And that is probably the greatest fear that I have, is that I am seeing us becoming increasingly more transactional, and therefore the underlying fragility is building and hiding in plain sight, just like the debt trap that we had that's hiding in plain sight. And that,
do you think that's do you think that's a first world problem or a world problem? Or, because I go to some countries and I don't have they're not sitting around with their phones all at the, they're at a table and they just made spaghetti and their whole family's there. Is that just an American problem where it's been so comfortable for so long and technology is just the boiling of the frog? In Africa, they're just now getting phones.
There's no question there's cultural differences. And You go to Italy and have meals, and when they show up at work and when they do is different. And maybe we ought to become more like them. But you raise a great question. That goes to a conversation much longer and deeper. But whether or not, how do we use technology in the right ways that make us more productive and extend us in the right ways, but don't take away the things that matter most? And I think that's hard.
Well, could it be that AI will be the thing that allows that to happen? Because technology, while it has improved our lives. It has been very much a robotic experience, but maybe AI coming into the picture can bring that more humanistic, remind us that there's this human part of interaction that we need to be remembering and be less transactional?
It's a brilliant question, and one I really haven't spent a lot of time, but I think it kind of circles back as to whether or not, if it's able to do that, will it be used to manipulate us in some way?
Have you seen Ex Machina? Have you seen that movie?
No, I haven't.
Okay, so there's you don't have to do the experiment because somebody already did the thought experiment. Just watch Ex Machina. It's a movie about, I can tell you everything, but it will give you perspective into that exact question right there. Watch it. It's really good. I do think that as these things get more advanced, this is going to be such an interesting place to be. You're in the middle of buying banks and doing all this. What are you focused on then for the next 18 to 24 months as a financial institution executive, keeping your eye on, a set of guiding principles? I know you have that. You got to remain resilient and innovate, and you have to remain that, those things. But from a more tactical over the next 18, 24 months, what are those things you're looking at and focusing on that you think will make a difference, allow you to weather that storm?
So I'm in the process of forming a bank holding company to be pre-positioned. The best way to describe it is like a blank check bank holding company that will be pre-positioned to help banking regulators resolve a distressed banking cycle if one comes, either by acquiring failed banks or recapping capital eroded banks. I think there's going to be a number of banks that will have capital erosion because of losses exceeding their loss reserves. And then the financial assets that clog the system will have to get cleared. We will get through whatever, if it happens, and it will happen eventually.
Something will happen eventually.
It's no question that the reset has to occur, just like stock market and anything else. Will occur. How long, how much pain, how deep, lots of questions yet to be determined. I don't pretend to be a prophet in that regard. But there are the cleanup guys. That's what I do. So, when trouble hits, that's where I go to help clean up trouble.
So what would you advise an institution to steer clear of right now in preparation for maybe this crunch, as somebody who's seen what are the things that will drag you down like a boat anchor if you don't get your head on straight? What are those two? And maybe we've already talked about them, but maybe just take us through those.
Well, you go back to financial services and you first start with a cost structure. At the end of the day, you can't outrun on the asset side, on credit risk, if your cost structure, both your cost of funds and your operating cost, are basically out of balance. We're going to go to a period of time likely in which cost effectiveness, the efficiency ratio, if you will, how well the machine, how well it oils and turns, is going to be first and foremost.
Mm-hmm.
Then second, this is probably not a time to be long on credit concentrations. I think risk diversification, it's a time to basically rebalance where you might have excessive risk.
With short to midterm positions or longer positions? Like how would you read, but what would you rebalance into?
So we're in the bank. If we're in the banking world, we're thinking about, credit and loans, and then securities, it's really the concentration lists that are multiples of your equity capital. So let's say you have a loan for commercial real estate at 300% of equity is exposed.
Yeah.
If the world stays together and no problems, okay, you can reap some additional income by being more conservative. But if the world changes in a hurry, you'll be trapped into those assets, and the loss will probably exceed the loss reserves.
So basically, just diversification is a very important
risk diversification.
risk diversification.
This is
Okay. Yep.
where risk diversification, and if you're a financial institution that's in the credit world,
Yep.
it's risk diversification. And the way to think about it is which outsized risk concentrations are multiples of your equity capital.
So you like some institutions like to focus on one thing and they get really deep into that, and now all of a sudden it's like, oh no.
We have certain institutions that have concentration in commercial real estate, as an example, that are 300+% of their equity capital. Now, as long as everything stays together, fine.
Yep.
But if the world changes, if it turns fast, you're trapped into those. You're going to suffer outsized losses.
Yep.
No, you're giving up some income, no question. There's trade-offs. There's trade-off in everything in life.
But that's where OpEx and operating expense and cost become super critical, because that can let you be more nimble. You don't have to worry about as much.
Or have liquidity. This would be another thing that I would say. In every cycle in the financial services world, we're going to see, it doesn't matter whether you're a bank or even a non-bank, liquidity.
Yeah.
This is a time for managers to really stress test their liquidity, because when you need it, you can't go find it.
How do you stress test liquidity? What is that mechanism?
Well, the banks have done it a long time for their asset liability modeling.
Oh, modeling. Stress test model.
Your stress test.
No, you meant like go out there and go stress test it.
Well, you might want to know how people trust you, because and that gets into uninsured deposits and other things on the banking side.
Yep.
But liquidity backups, backup liquidity, putting those lines in place today.
Yeah, that's what we've been seeing a lot of institutions doing is, figuring out new ways to get liquidity in the door now, as opposed to like, oh man, we need liquidity. Like, don't do it. Right. It's kind of like raising money. Don't go raise money when you absolutely need the money.
Yeah, exactly. And so no question, you're giving up. These are additional costs to prepare. And if things hold together and I'm wrong on the thesis, then great, people will have.
I agree with you on the thesis. I think
that it feels different. For sure, it's a different world.
Yeah. Oh, no doubt.
And for sure, there's a higher cost of capital that the Fed can't just cut rates.
Yeah.
And why do we know that? It just happened.
Yeah.
They cut rates by 100 basis points, and the 10-year has backed up.
Yeah.
That is a flashing red signal that I'm going to count on Fed lowering rates to take some of the pressure off will only go so far.
Yep. Yeah.
And people could be stranded on an island if they don't. That's that organizational resiliency thinking. At the same time, you still have to be innovative in everything, which would require, redundancy in systems and backups and all of that. No question there's a cost to all that. Won't sugarcoat that. But the worst is making bets or being oblivious to the disruptions externally and internally that can put you out of business.
And even if you go through this exercise of getting taking the next 18 months to get operationally efficient and diversify, are you going to be in a bad position if it takes 36 months for this? No.
You're going to be competitively advantaged because you'll have gone through the strategic. The team will have gone through it with you and all bought in. You'll find out who's with you and who's won't. You'll come back to this people. At the end of the day, no matter how tech-driven we get, you still come back to the people side. You got to have people trust each other Yeah, they may be skilled with technology, you may have great technology platforms, but at the end of the day, it's people.
It starts and ends, literally always starts and ends with people. Everything else is just kind of, and that's why we need to keep that relationship going. Well, man, Brad, this was just amazing. I think we're over time. I know that, you've got to get out of here. One last thing to leave you dropped a lot of bombs, wisdom bombs today. But if you've got one more in the tank, what would you leave our one last piece of advice you'd leave our listeners with?
A great question. I'm thinking about all things I've learned here today too, and gain more clarity. Probably the thing that I'm impressed to probably leave, this great audience. And by the way, let me credit you and the team.
Well, thank you.
Phenomenal.
Thank you so much.
It's been such a treat. In the corporate governance world that I'm in, and I've come to appreciate that it's the ability to ask the right questions at the right times for the right reasons, and then validate the right answers. And part of that comes from a learned ability to try to see the non-obvious. I use the words hiding in plain sight a lot because so many things are hiding in plain sight in front of us, culturally, socially, economically. And it's a skill that you have to think about, how would the world be different? And now, it's not just resiliency, it's also innovation as well. It's constantly thinking about, with a relentless pursuit of learning what you don't know that you need to know, that you can either manage or govern better, both yourself and with others. And then it really comes back to the 1 + 1 = 3, which is what you kind of were talking about with, DLT and AI. Oh, there's a 1 + 1 = 3 equation there. And I think it's something that we have to develop within our organizations to be able to see the non-obvious. Because everybody see the obvious, but it's the ability to see the non-obvious, ability to see both opportunities as well as risk, and then just relentless pursuit of knowledge that helps build trust, by the way. That common glue is something that people like to be around. The one thing, and this is interesting because you go, well, do AI machines like to learn? Well, I think they do.
I think they might, yeah.
On large language models. But we have to too. We have an intuitive part of who we are that just a voracious intellectual curiosity. I'm learning as much now as I ever have. And the more I learn, the more I realize how little I know and how much more I really do need to know.
Isn't that a crazy equation right there?
It's the spice of life.
Thank you so much, Brad. This was magnificent. We'll have to do it again sometime very soon.
Thank you very much.
Thank you.